So hello everyone and welcome to Career Launcher. So in today's class, we are going to discuss about important economic terms which always remains in the news like repo rate, cash reserve ratio, statutory liquidity ratio, forex reserve. Especially we will be talking about forex reserve because recently we have seen in recent days we have seen rupee devaluation and people are saying that perhaps it might dent our foreign exchange reserve. We have seen foreign portfolio investment declining in recent days. So that's why I have decided to discuss these things. We'll be discussing about Monetary Policy Committee, which is responsible for deciding repo rate, etc. in India. So let us begin with the today's class. So first we are going to discuss whatever is the discussion of today's class. So first of all, we'll be discussing about what is open market operation. And along with that, we will discuss what is bonds and government security. Because then only you will understand open market operation. Then we will understand repo rate, which is an example of open market operation. Then we will discuss CRR, that is cash reserve ratio. Then we will discuss SLR, statutory liquidity ratio. Then MPC, Monetary Policy Committee. And the last is foreign exchange reserve. So let us begin with the first one, that is open market operation. So it is what it does, it says it is an activity by a central bank to exchange liquidity in its currency with a bank or group of banks. So to understand that, first of all, we have to understand what is bond. Okay. So first of all, let us understand what exactly it is a bond. So bond, or sometimes in some terms they write it as debentures. So they are actually debt instrument. It is an instrument to take loan. Okay, what is debt instrument? So let's take an example. Let's say there's a company called as XYZ. This company wants to raise money. They want money. So one way is they can dilute the shares. They can sell the shares. So let's say they dilute their 10% share. People actually invest them back through IPO or any other method, right? This means people buying the shares of the company. So in that way, XYZ company can raise money. Another way is through bonds. So let's say this is a XYZ company. This company sells a bond. This is a bond. Sells it to the public. So people, right? So it means people will pay them. For example, let's say I'm assuming it. Let's say this bond is priced at 100 rupees. So face value is 100 rupee. The term is for 1 year. This bond is for 1 year. And let's say the interest rate is 3%. So it means people, the people actually, let's say you bought XYZ company, one bond of XYZ company. It means you have paid 100 rupees loan to XYZ company. This is the meaning of bond. If you have bought a 100 rupee debt of XYZ company, it means you have given 100 rupee loan to XYZ. Okay. Now you have given 100 rupee loan with term of 1 year, for 1 year, and interest rate 3%. So after 1 year, you will get back, you will take this bond to the company, usko वापस लेके जाओगे, and you will get that 100 rupee back, plus you will get the interest of 3 rupees. है ना? So this is a very simple example of this. So I hope you understand. So a bond is a debt instrument. Now, so I have just given an example of XYZ company issuing this bond. So whosoever is issuing bond is taking loan. So for example, if XYZ company is issuing bond, it means it is taking loan. Similarly, this can be issued by the government also. If the government issues this, if the government wants to raise money from the people, so people can buy them, and this and people can pay for it. This is actually in that case called as government security. I hope it is very much clear. So it means government security. If the government is issuing government security, it means the government is taking loan, right? That is how it works. So this is government security. Now, this government security, let's say you bought this government security. Now you can sell it to someone else also. That is how the trading of government securities also happen. And government security is also traded between RBI and central bank. For example, if RBI has government security in their pocket or in their almirah, they are selling this. Let's say they bought from a government and a government security. Now RBI has a lot of government security. If they sell this to a commercial bank, let's say ICICI Bank or any other bank, it means they are selling the government security. It means this bank is giving loan to RBI. That is how it works. This is called as reverse repo rate. Reverse repo rate ka concept hai. But let's take an example of opposite, because that is called as repo rate. So bank giving government security. Government bank also has government security in their deposit. Let's say so the bank gives government security to RBI. It means the bank is taking loan. And this is acting as a collateral that, okay, this is the page, this is the paper I'm giving you. You give me the loan of, let's say, 10 crore. I'm just giving example. This is the principal amount. Let's say the interest rate is 4%. And let's say the time period is for 7 days. Okay. Now the bank is giving government security, and in lieu of that, the RBI is giving the money. So this R is actually nothing but repo rate. Interest rate at which bank takes loan from RBI. So bank is taking loan, and they are providing government security as collateral that we are giving. Okay, let's look it. And this is for 7 days. It means what happens is after 7 days, the bank says, I will repurchase this government security back from you. Okay. So the bank says that after 7 days, I will give you back this 10 crore rupees by taking the government security back. So I will repurchase your government security by paying 10 crore rupees plus the interest. That is why this word repurchase, that's why the term repo rate comes, repurchase agreement. So repo means, so when you read about repo rate, it actually says repurchase agreement. The RBI, let's say the bank says, any bank, let's say ICICI, HDFC, any bank, they says that, okay, we are selling this government security to RBI. RBI is giving loan to them. And generally, you should know that it is a short term. Secured means, of course, you are taking it from, it's a secured because government security is acting as a collateral. Short term means less than 1 year. Hai na? So basically, the bank says that, okay, we are giving this government security to RBI, and RBI is giving the loan. So let's say the loan is of 1 crore or 10 crore rupees with an interest rate of 3% or 4%, let's say, and 7 days. Because repo rate is for short term, 7 days, 14 days, 28 days, like that. So when the government bank is selling the government security, it promises that I will repurchase this. So right now I'm taking loan of 10 crore rupees, but I will repurchase this government security back by paying you the 10 crore rupees plus along with the interest. And this interest is nothing but repo rate. Okay. And this is also an example of open market operation. What is open market operation? Open market operation means any trade in government security, like RBI doing trade with bank, or any two X, Y, both are trading in government securities. That's called as open market operation in one line. Okay. So basically, this repo rate transaction is also an example of open market operation. This is what you should be knowing about. Now, this is called as repo rate. There's another term which is being used a lot. That's called as reverse repo rate. What does this mean? So it is exactly the opposite. If RBI is selling government security to the bank, any scheduled commercial bank, let's say ICICI, so it means RBI is taking loan. And please do not ask me why RBI takes loan, but there are a lot of reasons. Okay. Let's say 10 crore loan. So now RBI promises that, okay, I will buy this government security back by paying you the principal amount along with, let's say, the 2% is the reverse repo rate. Generally, reverse repo rate are lesser than a repo rate. Okay. I hope it is clear. And this is also called as policy rates. Okay. That's what you should be knowing. Okay. Now, this is open market operation. I've given you a rough idea about it. Government securities, government security trade, etc. And you can read it. Actually, I have attached an example which I've got from Gemini. You can search it and you can read it. What does actually they have given a real life example of that. You can read it, and then you will understand the idea behind this. Okay. Otherwise, whatever I've explained, that is more than enough for your understanding point of view. Now, this is actually with regards to how the repo rate controls inflation in the economy. Okay, let's maybe future may will be having one more class if possible with regards to that. Okay, let's move on to the concept of cash reserve ratio. So cash reserve ratio is like this. Okay, you can read this example, interesting example given by the AI, artificial intelligence, Gemini. I have searched and they had given a real life example just to show you. You can read it. Pause the video and read. Now, what exactly it is cash reserve ratio? It is like this. Okay, so let's say this is a bank. Okay. Now, how does bank work? I'm sure this is a basic thing. You do not require any rocket science for that. That actually it takes money. It actually takes money from the depositor. So depositors deposit money. Now the bank extend loans to the people. So let's say depositors deposit money and the bank is giving 3% interest back to them. But when bank extend loans, they charge more interest rate for housing loans, for car loans, etc. 4%, 5%. And the gap between the two is the earning of bank, right? That is how it works. Now the thing is, for example, the bank today actually has 100 crore rupee from depositor. Depositors deposited 100 crore rupee. Should the bank extend all 100 crore to the loans as a loan? No. Because if the depositor will come withdrawing the money, what will happen? Kilao mera paisa lao. What will happen? In that case, the bank will collapse. There will be panic. Kya bank mein paisa hi nahi hai. So the RBI has maintained a lot of reserves to ensure shock absorption. So for example, the RBI says that, okay, depositors have come. I'm writing D for depositors. Depositors have come and put 100 crore rupee in your bank. Okay. Now they want to extend all money because bank want to earn money. So they will extend all the money. But RBI says, no, stop, wait, ruk jao. You give me, let's say, I'm assuming cash reserve ratio to be 4%. Okay, let's see. So RBI says, whatever your money is having, please give to me, to RBI, 4% of this. The cash reserve ratio of 4% means 4 crore rupee in my account. Just you keep it in my Almira. I'm just giving example to understand. You come home and you come to my house and our office and give me this much amount of money in my Almira. I will keep it as a safe in my Almira. It does not require any interest. So 0% interest rate. There's no interest. Means RBI is not taking loan. So RBI does not say you keep me 4 crore rupees. I'll give you loan interest on that. No. RBI will not give any interest. This is just for shock absorption. You give me 4% of whatever you have. So let's say 4 crore rupees. Give it to me. I will keep it in my Almira. That's it. Just for a shock absorption. This is called as CRR. The RBI does not give any interest on that. Okay? This is one safety net. Another is called as statutory liquidity ratio. What we call it as SLR. So this is also a very interesting example of it. You can read about it. I've attached for you. Now the RBI says कि नहीं इसी से काम नहीं चलेगा. Not only cash reserve ratio itself is not important. So let's say the bank is having 100 crore rupees with themselves. Now the RBI says before extending, you have to give me this CRR cash reserve ratio. Let's say it's 4%. So 4 crore rupees to me in my Almira. So RBI has kept in this Almira. अपने Almira में रख दिया 4 crore in इस बैंक का. Now RBI says that rest 96 crore is left. You are not supposed to extend all 96 crore. So let's say statutory liquidity ratio is, let's say 20%. I'm just giving example. I don't know right now. I need to check it. But okay, 20%. So RBI says keep 20% of that with you. So 20 crore, keep it in your Almira. अपने Almira में रखो. You are not supposed to extend loan on that. And that can be, for example, CRR is strictly in cash. That 4 crore rupee you will give in cash. No interest, है ना? But this is SLR. This 20 crore you are supposed to keep it in your Almira. You are not supposed to extend loans on that. That can be the form of cash, gold, or government bonds, or government security, what we call in India. So bonds, gold, cash, or government bonds. In this amount, in this form, you can have SLR in your bank account. The bank is supposed to keep it in their Almira. So they are left with 20 plus 4, 24 crore. Rest 76 crore they can extend. That's the idea behind this. I hope you got it. 4 करोड़ आपने 4% जो भी CRR था RBI को दे दिया कि अपने अलमीरा में रखे. 20% जो SLR अगर मान लीजिए 20% है तो 20 करोड़ अपने पास रखे रहना, उसका लोन नहीं देना किसी को. Rest 76 crore you can extend loans as car loan, home loan, house loan, whatever it is, and then earn money from that. So this SLR and CRR are for shock absorption. That is what you have to understand. Hana. In case if something goes wrong, if people start withdrawing money, then in that case, Hana, there has to be something. Na? And of course, in SLR, you can earn interest. The bank can earn interest if they have invested in government bonds. Because of course, government bonds is interest based. So you can earn money from that. Okay? That is what you should be doing. I hope you got the idea. I can plan, let's say, right now we are talking about CRR, cash reserve ratio, statutory liquidity ratio, foreign exchange reserve. So maybe in the next class or next to next, whenever we'll get a time, I'll tell you how this actually CRR, SLR, repo rate, these impacts inflation in India. Okay. So first understand this concept. Once you learn it, we will discuss it further. Okay. Let's move on. Monetary Policy Committee. This is very important. Now, who decides what is repo rate? So generally we say RBI, but it was true till 2016. After 2016, it might not be true to say that RBI is responsible for it only. So there's a committee called as Monetary Policy Committee. established in 2016. Now, this monetary policy committee comprises of 6 people. So 3 from RBI and 3 from central government. Okay, that is what you should be knowing. Now, out of these 3 from RBI, one is an RBI governor who is the ex officio chairperson of monetary policy committee. So ex officio chairperson means by default, whosoever is the RBI governor will automatically become the chairperson of monetary policy committee. Okay, so that's called Mr. Sanjay Malhotra. Right now is the governor of RBI. Okay, and they set benchmark interest rate, so they are referring to repo rate actually. And we will discuss in the upcoming, most likely in the next class or whenever we'll get a time, of how actually the interest rate impacts or the repo rate, tweaking of repo rate impacts inflation in India. Okay. Okay. And there's a target. So monetary policy committee has a target of inflation target of what? 4 plus minus 2%. So 4 plus minus 2%. So it means from 2% to 6%. That is what you should be knowing. Okay. So right now I saw this few days back, and in the RBI's website they had written policy rate is 5.25%. This you should know. Then CRR was 3%, SLR was 18%. I was giving example of 4% and 20% here, but that was an example. Right now this is the case. Okay. You should know the basic one. There are other rates also which you are not supposed to know. At least these things are important. This is the exchange rate. Now let's talk about foreign exchange reserve. This is also very important. Forex means foreign exchange reserve. Okay. Now what does it mean, foreign exchange reserve? What does it mean? It is like this, I'll tell you. For example, let's say this is India. You want to import anything from America. You want to buy a, let's say, shirt from America. So you have to pay in dollars. For example, this shirt is costing, let's say, $20. So you will pay in $10 to $20. But where will you get dollar? You have rupee in India. So RBI has foreign exchange reserve. Or like, so you will go to RBI and ask for foreign exchange reserve. You will pay rupee and ask for dollar. And this dollar you can invest in buying, importing. So this is one example, but of course you will say, sir, I will go to the nearby exchange bank. Yes, fine. But that is a smaller level. At a bigger level, it is the RBI who keeps all the foreign exchange reserve. So if you have to import something, not only from US, even if you are importing, let's say from Saudi Arabia, you are supposed to pay in dollars. Most of the international transaction happens in dollars. Okay. So for example, let's say you imported something from America. So when you're importing something, your dollar is decreasing. Dollar will reduce. So if you import something, your foreign exchange reserve will go down. Yes, because you have to pay in dollars. But if you're exporting something, you will earn foreign exchange reserve, right? That is very important. This is the basic concept of the foreign exchange reserve. That is why, I'm sure you must be aware, a lot of Indians live in Arab countries and different places. And when they send back money, the government does not ask for any income tax. The reason is the government is earning foreign exchange reserve. And why it is important? Because India imports almost 85% of oil, crude oil. So in that, foreign exchange reserve is very helpful because we have to pay in dollars. So we have to earn from dollar also. So that is why India is one of the biggest remittance earner from other places. Remittance earner. And this is a very good sign for Indian economy to have remittance earning. If God forbid something goes wrong, for example, in Gulf country, if there is severe crisis, God forbid, then of course a lot of Indians might return. There will be a lot of unemployment crisis, plus remittance will go down, foreign exchange reserve will go down further. So that's why India is the largest receiver of remittance, which is very good for India. So foreign exchange reserve comprises of these things. First is foreign currency asset, which includes dollars, euro, pound, etc. But dollar is the most important, right? Then we have gold. Then we have special drawing rights and reserve transition position. These two are related with IMF, International Monetary Fund. We are not going in that detail. But just have an idea. Most of them, like 70%, 60-70% at least of the total forex comes from foreign currency asset, that is dollars, etc. I hope you got the concept. So basically, largest foreign exchange reserve is of China, then Japan, then Switzerland, then Russia, and then we have right now fifth. Okay, so a few days back I had seen it was somewhere around $700 billion, but now it is $638 million something. So please keep on checking it. It keeps on fluctuating. So this is of 15th May. Okay, so recently we have seen decline in foreign exchange reserve. It had crossed $700 billion, and the reason is import bill has increased. Import of oil bill, है ना? So because we are importing oil, almost 85% we are importing oil. So we have to pay in dollars. And the prices have increased. So of course we have to pay in dollars, and because of which foreign exchange reserve has slightly gone down. It is good enough. It is. I'm not saying that, but we have to be very careful of that. First. Second thing is, this was a very sad news for us. That is, foreign portfolio investment has heavily withdrawn from India. So one is called as FDI, foreign direct investment. Here actually they invest not only in stocks, shares, bonds. They invest properly in the company. Let's say BMW, a German company, is setting a plant in India, let's say in Chennai. So they are not only actually they are coming up with transfer of technology, they are setting up the entire plant. So that's the example of FDI, foreign direct investment. But FPI means you are investing only in shares, bonds, etc. And that too, share should be less than 10%. If it is more than 10%, it will be called as foreign direct investment. So foreign portfolio investment, they are considered as hot money because they are very volatile. You can very easily withdraw from FPI. And I'll tell you example between FPI and FDI. For example, if a BMW has set up a plant in India, in Chennai. BMW is a German car maker company. I'm sure you must have heard. They have set up a plant. So they have come up with money, transfer of technology. They might have sent their own engineers. So this is called as FDI. Withdrawing FDI is difficult because you have to actually withdraw all the plants and everything, which is difficult. But let's say the BMW let's take another example. Okay. Let's say Ford is an American car company. They have bought a share in Tata, a 5% share in Tata. This is called as foreign portfolio investment. If they are buying less than 10% share, if they are buying more than 10% share, then of course, again, it will come in FDI. So if they have bought a share or a small amount of a bond or a share, they have bought, let's say, less than 10%. So they have bought a 5% share in Tata. It is very easy to withdraw back. Why? Because they will sell the share and go back. But what is problematic? If the Ford is having a share in Tata, I'm just giving example. I don't know whether they have share, but that's for understanding. 5% share. Now the Ford wants to sell it. So Ford will sell in India. They will get the rupee. But they will not take rupee back. So they will translate from dollar. So the demand of dollar will increase. When the demand of dollar will increase, the Indian rupee will become weak. So one of the reasons for Indian rupee getting weak is because of FPI pulling. Foreign portfolio investors pulling in heavy amount. First, because they are demanding dollar. So they are selling their shares. They will get the rupee. They will convert that to dollar. They will ask for dollar in Indian market, and they will go back. So one of the reasons for the weakening of rupee is this. Another is, I'm sure you must be aware, oil import has increased. So again, you have to import it. So it means you have to demand dollar. Once you demand dollar, your rupee will get weak. So there's a graph actually. This is actually supply demand graph. Dollar. So for example, if the dollar's demand will increase, it will go something like this. So earlier, let's say this was $1 is equal to 80 rupees. So now it will get more weak. It will become $1 is equal to 100 rupees. Okay. That is what you should be knowing about. Okay. Now, so that is how the concept works. Now, I'm sure you must be aware, if the rupee is weak, if the rupee is weak, it is good for export and bad for import. This you should be knowing. Okay. And this is very simple example. For example, you have exported something from India. You have exported something to America. You got the dollar, let's say $10. This $10, you will go to the Indian market and ask for rupee. So you will get more rupee when the rupee is weak. For example, $1 is 80 rupee and $1 is 100 rupees. So the next one is actually, this one is a weak rupee. So when you will take $10 you have earned, you go to the RBI or any exchange bank, you will get more money in this case, second case. Right? That is how. So you should remember that if the rupee is weak, you will get, exporters will get benefit and importers will be at loss. But the question, now what should be the net response? Net result is very, very much import dependent. So overall, always remember, for India's case, I'm not saying for other countries. because in China it is good for being weak yuan for them, but for us overall, if the rupee weakens, overall it is bad for India. Okay, just remember it. Okay, so we are stopping this class here. I've given you a rough idea. Maybe if we'll get a chance, we can have another economics class. So please subscribe to our channel, press the like button, share this video.